We no longer have to wait for the end of the quarter to understand where the economy is moving. Capital is now deployed based on real-time crowd intelligence rather than lagging indicators. This chart plots a real-time prediction probability curve against traditional polling data. Binary event contracts, simple yes or no propositions, force participants to put capital behind their beliefs, mathematically aggregating decentralized intelligence. This mechanism allows prediction markets to lead traditional expert consensus by several weeks. Financial incentives force these prices to reflect reality. A full month before an event resolution, these aggregated probabilities maintain an accuracy rate exceeding 94%. By 2026, the sector has expanded into a $44 billion market. This space is currently held by a structural duopoly, Kalshi and Polymarket. Institutional funds treat these crowdsourced probabilities as Tier 1 financial signal engines, using them as mandatory inputs for pricing global risk. This diagram illustrates the structural divide within the $44 billion market, separating strict regulatory compliance from decentralized permissionless scale. Kalshi operates on a top-down model built around a CFTC license. The CFTC, or Commodity Futures Trading Commission, is the federal agency that regulates the U.S. derivatives markets. Their DCM license, or Designated Contract Market License, allows Kalshi to connect to fiat banking rails and run a traditional central limit order book. This regulatory status puts Kalshi on the same legal footing as legacy institutions like the Chicago Mercantile Exchange. Polymarket uses a decentralized model. USDC crypto rails flow into an AMM layer, or automated market maker, a protocol that uses liquidity pools to price outcomes, which is settled by decentralized oracles. This bypasses regional CIOT regulations to tap into global liquidity. These infrastructures dictate different fee models. Kalshi charges a variable transaction fee between 7 cents and $1.74 per 100 contracts, while Polymarket offers zero-fee trading with a 1.5% withdrawal toll. These foundation layers determine the types of traders each platform attracts and the specific categories of risk they are able to price. This dashboard breaks down a $5.9 billion volume block. Kalshi holds 57%, with Polymarket capturing 43%. Kalshi leads in transaction count, processing 48.8 million trades compared to Polymarket's 21.4 million. This shows extreme liquidity concentration. Over 90% of Kalshi's volume is regulated sports forecasting, seeing $86 million daily. Polymarket is the venue for macro risk, led by politics at $105 million and crypto at $95 million. Depth trumps breadth. Dense liquidity is required to tighten spreads and prevent execution slippage. Kalshi captures massive retail flow by integrating directly into consumer trading apps, reaching a pool of 27 million potential traders. They supplement this with exclusive API integrations from major news networks, which broadcast Kalshi's prediction data to a global audience in real time. The market has effectively split. Kalshi monetizes mainstream retail attention through traditional partnerships, while Polymarket acts as a permissionless global hedge against systemic uncertainty. Professional funds synthesize qualitative prediction probabilities with quantitative derivatives flow to identify high-conviction trades. This gauge displays two distinct metrics. The needle shows the probability price, the market's current guess, while the volume beneath it represents open interest, or OI. OI measures the total dollar value of unsettled contracts, reflecting the actual capital depth and conviction behind the price. During the 2026 AI infrastructure shift, institutional traders utilized these signals to identify major dislocations between public sentiment and private positioning. Traders use this setup to gauge market layers. The first monitor tracks Polymarket probabilities, showing retail sentiment on the best AI models. They cross-reference this with institutional dark pool accumulation of deep-in-the-money leaps, options contracts extending beyond 1 year. This options flow is driven by massive hardware capex commitments, with institutions positioning for a major infrastructure breakout. This positioning is supported by fundamental data like Oracle's $553 billion RPO. RPO, or remaining performance obligation, measures the total value of future revenue under contract that has not yet been recognized. Identifying the gap between retail sentiment on prediction markets and institutional derivatives positioning generates actionable alpha. Elite funds use prediction market open interest to map the terrain of uncertainty, identifying price gaps they can exploit in traditional equity markets. The initial duopoly was defined by a boundary between regulated fiat execution and permissionless crypto scale. That boundary began to fade when decentralized prediction odds were integrated into the Bloomberg terminal, signifying their transition into legitimate institutional data. Legacy financial giants are now investing heavily in this infrastructure, as seen with ICE's $2 billion strategic investment into Polymarket. Paradoxically, the fiat-native Kalshi is now embedding its data into decentralized exchanges, like Jupiter, to serve as a specialized compliance layer. These two distinct architectures are converging into a single data pipeline that prices risk across both traditional and decentralized finance. These markets do not replace institutional judgment. They quantify the exact market price of uncertainty. In the volatility of 2026, waiting for a lagging quarterly report is no longer a viable strategy for risk management. In an era defined by rapid AI deployment and geopolitical friction, real-time prediction market probabilities have moved from niche academic tools to a core component of the global financial stack.